Hello, guys. Welcome to another episode of the Multifamily Master Summit podcast. Today, as we have Beau Beery, a broker, a real estate professional, and author of the book Multifamily Investors Who Dominate. He has two kids, but his true passion is his Porsche 911 Turbo S. Am I right or not?
Yeah. You're right. I'm a big fan of Porsche.
Thanks for coming, Beau.
You bet. Thanks for having me on, man.
So, how about we start with your multifamily journey?
Well, I started in the late 1990s. I was doing on-site leasing and management on a new apartment complex construction for Tremel Crow Residential, which was one of the largest apartment developers in the country at the time. Fell in love with the business, watching basically 800 people pay for a $30 million asset was pretty cool. And I never saw the owners. From there, I went back to school. I had a passion for real estate, got a master's degree in real estate at the University of Florida. Went and worked for a developer that also bought office, retail, and multifamily. And I brokered and managed the assets. And then in 2010, I acquired a Coldwell Banker commercial and a Coldwell Banker franchise, two real estate brokerages with a few partners. My partners ran the business, and all I did was sell multifamily and a few other assets. And then I sold back my share in those companies last year. And now I just have my own boutique multifamily brokerage firm starting in 2021.
Nice, just fresh new. Now, Beau here, I wanted to talk about some concepts you mentioned in your awesome channel, Beau Knows Multifamily. And I want to put this into a test here with me and our audience to see how much do you know about multifamily? And yeah, Beau, as it's called Beau Knows Multifamily. If you search that on YouTube, it should be the first hit. So let's start with this concept that I found quite amusing. What is the Michael Jordan effect in real estate investing?
So Michael Jordan, obviously, arguably one of the greatest basketball players in the history of the world. Many people feel like he got too many calls to go his way. So when there was kind of a gray area on a call, Michael Jordan would get the benefit of the doubt. And many thought it was because he was just so good, right? Referees would give him the pass, but that's not the case. What was happening was as Michael was developing relationships with those referees, both on and off the court. And instead of being the player that when a call didn't go his way, instead of cussing and throwing things and belittling the referees, he befriends them and he's nice with them. And, he talks about their kids and their hobbies and what they did on the weekend. And so what happens is over the course of a career, when you play well and you develop relationships with referees, you get calls to go your way. And that's just business. That's life. And so in real estate investing, it's much the same way. The referees, are the brokers and the sellers. And, developing a reputation and playing nice and developing relationships earns you more looks at deals, earns you more calls, if you will. And the more assets you have that you can look at, the bigger the probability is that you'll actually buy one of those. That's the Michael Jordan
a beautiful
effect.
Approach. Yeah, and smile a lot. Yeah, you had a beautiful smile. So make sure you also add the smile into it. Yeah, right. The brokers and the sellers, they'll love you. The next concept is the law of the big mo, as author John C. Maxwell would put it. Yeah. And you mentioned this in one of your videos that you kind of cherish this concept. Can you explain to us how important it is to have a momentum?
Sure. Yeah. So the law of the big mo is momentum. And what that means is whenever once you've bought your first, buying your first property is the hardest, right? Once you've bought that first apartment complex, the next one becomes easier because you've now developed a name and a reputation. And as long as the transaction went well and it closed well and you left with a good reputation, brokers and sellers want to bring you more deals, right? And so that second deal is a little bit easier. And then if that one went well, the third deal becomes even easier. And then you build this momentum ball. Like you're the new kid on the block or the old kid that's continuing to do things right over and over again. And the more momentum you build, the more properties you buy, the more times you do things correctly, the more times brokers and sellers want to bring you assets, because you're easy to work with. You're easy to close a deal with. You don't bring up issues during transactions, and you don't retrade, and you don't belittle properties. And you're just someone who's easy to get deals done with. And that momentum, as long as you can keep the momentum going, it's much easier to keep the momentum going than to have to restart it again. And so the law of the big momentum is basically like you're just this big ball rolling down a hill, and there ain't nothing that can get in your way because you're doing everything right.
Nice. And how is your momentum right now, Beau?
I've been keeping the momentum going since the 90s, man. I try to just keep a good reputation. I try to keep I try to just do things right. I try to treat other people right. I try to put the other person's, I try to use empathy. I try to put the other person's, sort of hat on, if you will, and make decisions that way rather than making decisions from my wallet.
Yeah, exactly. And I hope your momentum will keep on growing. Let's see. Okay, well, the next concept is a backup offer in multifamily. Yeah, because it seems quite regular to see them, but you were kind of fascinated to talk about them.
Yeah, I mean, backup offers are common when you're buying a single family home, but they're actually pretty rare in multifamily investing. And so what happens is almost every deal has, 8 to 15 offers, okay, on a transaction. And once the chosen buyer is the winner, then what happens is the broker usually calls back the other folks who didn't win the asset and lets them know they didn't get it and maybe some things they could do better next time. And then all those losing buyers go on about their way. But if you can turn in backup offers, actual, fully created purchase and sale agreements signed by the buyer, and produce that for the broker, what happens is it makes it a lot easier for the seller and the broker to come back to you if the chosen buyer somehow defaults or backs out or whatever the case may be. If the seller has an actual purchase contract from you as a backup offer in front of them, they can review the deal. They can look at some issues or some things they like or don't like. They're more familiar with you right off the bat, so that if the chosen buyer somehow doesn't work out, if you've got 13 other buyers back there, but you don't have any offers from them, you haven't reviewed their purchase and sale agreement, it's a little bit easier to do a deal or start with the backup offer person, as long as the backup offer was pretty daggum close. Now, you can't, in a 15 offer situation, if you were 9th or 10th place, there's probably no reason to turn in a backup offer. Okay. But if you were among the sort of the best and final offers, if you were among the top 3 or 4 in that scenario, I would turn in backup offers. It just increases your odds of being the chosen person in case something happens.
Nice. And it looks like a good hint, and it's coming not only, of course, here on our podcast, we've had like many investors, but Beau here is the first broker. So it's also good to check other perspectives like this one. Yes. And the last question, sorry, I'm going so specific in asking you questions. Yeah. I'm just testing your knowledge, okay? Sure. So the next one is, you mentioned cap rates are worthless in multifamily investing. Yeah. Why is that?
I get so many calls from buyers, like particularly if I have a new listing, or I just hear buyers talking in conversations. I hear this on podcasts. Everyone talks about cap rates. Cap rates are worthless, in my opinion, and in just about everyone else's opinion who actually buys a lot of assets, because cap rates are only based on the seller's income, which the buyer's going to be able to change. That's why they're buying it, so they can add value, minus the seller's vacancy, which you may or may not experience, minus the seller's expenses, which will look nothing like your expenses when you buy it, particularly after property taxes adjust. You may have different management fees. You may have a different insurance cost. You may save money on repairs and maintenance. All that equals a net income that the buyer will never experience, divided by a purchase price. So it has no bearing whatsoever on what the buyer will experience moving forward. every deal should be bought off the IRR. The IRR and the cash on cash returns, that's how the most prolific buyers are buying assets. The IRR takes into consideration not just that first day of purchase and ownership, but it takes into consideration every year after and what you think you can reasonably sell it for in 5 years, 10 years, 20 years, or whatever it is. That's what you're buying it for. A cap rate is literally the day one point in time of the seller's history, not yours. Okay. But 8 years from now, so for instance, what happens is when a listing gets put out and you see a 4.0% cap rate, okay, most buyers just hang up the phone or delete the email. But if they actually, do the calculations, run the full scenario on it, and see that over a 7 or 10 year hold, they've got a 15, 16, 17% IRR, why wouldn't you buy that, right? Again, if you bought it a 4 cap and 5 years from now, you go and sell that and make millions of dollars, or you keep it 5 years from now and the cash flow is significant and it's where you want to be, does it really matter what the cap rate was? No, because time cures things very, very quickly in this business. It's the power of returns, of rate of return. It's compounding. So anyway, just cap rates never made sense to me as a metric. Cap rates only make sense if you are buying new construction apartments or an asset that has already been completely and fully value added. Like there is literally nothing you can do to improve it. That's the only time a cap rate makes any sense.
Yeah, but as you said, it's still a metric, it's still an indicator that can be a part of your underwriting. So you're saying that you really don't consider nothing.
I don't think it is a metric. I think it's a worthless metric. It's only, if you are buying an asset that cannot be improved upon at all, which is hardly anybody I know, no one's buying assets these days unless you're a REIT or a national and you're buying a new construction deal. Everyone else is looking to add value. And so if you're looking to add value, why would cap rates be something that you base that off of? That doesn't make any sense to me.
Yeah, I know what you mean. And it makes sense that it doesn't make any sense.
Right.
So you seem to know this inside out. I'm not going to test your multifamily knowledge much more, but as we've had only investors here, we want to know this from you. So what do brokers know that investors don't?
The main thing that investors have, even some of the best investors, is they don't understand how few inventory there actually is in any one market, and how few assets actually sell in any one year. The rarity of these assets, if investors knew, would paint a better light on why it's so normal to have so few opportunities. So for instance, I cover the northern half of Florida. Now, Florida is arguably one of the top 5 states in the entire United States for multifamily. I don't think anyone would argue with that. It's probably in the top 3. I cover the northern half of Florida, which is from Orlando, Lakeland, Winter Haven is kind of my southern border, all the way up to Tallahassee and from coast to coast. There's only 1,959 assets over 10 units. That's it. And there's only 866 assets over 100 units. That's it. Those 866 assets that are over 100 units, if you were a buyer who only bought conventional deals over 100 units, in other words, you didn't buy student housing and you didn't buy affordable housing, there's only a little over 500 of them. And if you only bought the assets that are no more than 40 years old and no newer than, say, in the past 10 years or so, there's only 300 and something assets in the entire northern half of Florida, right? And right now, only 6.6% of inventory trades per year in any one market. So in that scenario, let's just say there's only 300 conventional assets that are built between 1980 and 2010 in the entire northern half of Florida, right? You're only going to have, there's only going to be 24, or there's only going to be like 24 of those that will sell in the entire year. That's 2 a month, right? And so what's important is that if there's only, and by the way, of those 24, several of them will be priced at prices you won't pay anyway. They'll be in locations you may not consider. They could have other physical attributes that you don't buy. Like there's some people who just they won't buy anything that's on the coast, or they won't buy anything that has flat roofs, or whatever the case may be. That 300 gets narrowed down very quickly. And so anyway, I have found that on any buyer's specific criteria, there are usually only between 1 and 2 transactions per month in the entire northern half of Florida that would match what they're after. That's it. Right? So you can underwrite hundreds. That's why it's really important to cover a very large area. The best investors I work with, no one invests in a market. No one invests in just Jacksonville or just Daytona Beach. They usually cover actually several states or several markets within several states. These are markets that they know. The balance is you have to cover enough geographic area in order to have enough number of sales that, based on what you think your market share can be, equals the number of deals you do. But that has to be balanced with being able to master those markets, every metric. How many things sold, what the rents are, what the occupancies are, absorption, market indicators, jobs, all that stuff. The best investors have mastered all of those things. So you can't just cover 6 states, okay? Because then you're not going to be good at any one of them unless you have a huge team that can become experts in each of those states. Most of the most prolific buyers in the country are only between 2 and 10 person companies. So you can't be a master at too much of a geographic area.
Yeah. And you seem to show a lot of knowledge on the Florida market. That's maybe like a competitive advantage over the investors, that sometimes they don't know the market that well. I guess that's your job, right?
Yeah, that's right.
So you created this brokerage in 2020, 2021?
I mean, my own brokerage in 2021, but I owned the other brokerage for the 10 years previous to that.
Okay. So this, why did you choose to create your own, and how has been the experience so far?
Yeah. I just, I have a coach that I've been with for a number of years, probably almost a decade. And I'm working on building my own personal brand, the Beau Knows Multifamily brand, in order to do some really cool things down the road, in just call it several years from now in my career, to be able to add on some different services that will piggyback off my brand. And being under another brand, whether it be Coldwell Banker Commercial or any other brokerage, doesn't suit that goal. So it was an opportune time in the market to be able to sell back or partner back the previous brokerage to my partners, and then start my own. And there's really been no difference whatsoever. I've always been a big believer that investors work with agents; they don't work with companies. Nobody chooses to work with only CB Richard Ellis or only Marcus and Millichap. Usually they become attached to really good agents within certain companies. Once they've done a lot of business with those agents could do or go anywhere they want, and that business will come with them, right? So same for me. I'm kind of a middle market broker. Most of my transactions are anywhere from 20 units on the low end to 200 units. That's kind of where the vast majority of my transactions are. I've done a lot of them more than 200 units. I've done some less than 20 units. But my trailing 5-year average usually works out in that middle. And so my customer is different from, say, the largest brokerage in the world or largest real estate company in the world, like CB Richard Ellis. A lot of the assets they get to work on are larger assets, 200, 250 plus units. And so the importance of being a national brokerage for those types of assets is imperative, right? Because the folks who buy and sell, call it institutional grade assets, primarily only work with larger national and publicly traded brokerages.
I guess that goes all the way into a bit of politics as well, right? With those big
Somewhat, yeah. I mean,
enterprises.
if you're the person in charge of selling an $85 million asset in Orlando, you need to be able to tell your investors, because there's hundreds, if not thousands of investors who have a piece of that deal, that you have chosen a significant enough brokers to represent that asset so that you don't lose your job in case something goes wrong.
Exactly.
Right.
And I guess choosing one of those top dollar brokerage, big ones, I guess the risk is lesser than if you choose a
It
single
is. I mean,
personality or identity.
yeah. And listen, there are a number of phenomenal, call it independent brokerages. Like I'm an independent brokerage. There's a small number of independent brokerages that are outstanding at what they do, even on some of the institutional assets. That's just not who I market to. I could have. It's just not who I market to. I know a couple of groups who are fantastic at it and beat out national brokerages on a regular basis, but that's something that they've built themselves towards for their entire career.
But as an independent broker, how do you make deals reach your desk?
It's all relationships, man. I'm very database driven, and I use the database to drive the relationships. So I use a CRM called RealNex. You can use whatever CRM you want, but the CRMs allow me to systematically maintain relationships with large volumes of investors. Now, as I told you, out of the 996 investors that own all of the assets over 10 units in the northern half of Florida, the reality is that I have a subset that I do 79% of my business with, which is what I call my rank A customers. So there's about 144 customers out of those 959 that I regularly trade with. And of those 144, there's about 25 of them that I trade with even more, just very, very frequently per year. And so that's the truth among many top level brokers, is they all have their subset of best investors that they take all their business to. It's very rare that someone outside of that 144 comes in and beats out the other buyers. Not that because the broker is able to steer towards their favorites. It's just usually because the favorites are the favorites because they're good at what they do, right? And sellers notice that as well.
Yeah, exactly. And the relationships must have been one of the weapons that you also used to build a wide network of brokers. I saw that you created one, and it's basically, if I want to sell something, you can communicate to them, right? And basically everyone will be aware that you're selling the asset, or if you want to buy something. How did you build that network?
So when I started out many years ago, let's call it 20 years ago, using the same CRM, I started my business by exporting every single property owner. So all 1,959 assets, I exported from property appraiser websites into Excel spreadsheet form. Most municipalities have that ability. I then spent months and months, diving deeper into the columns and rows of the spreadsheet to make sure I have every principal's name, phone number, email address, articles about them, assets they own, everything about the asset, number of units, bedrooms, age, when it's sold, who it's sold to, every metric you can think of. And then I imported all that data into a CRM and have made it searchable. So when I get a listing, let's say I get a 115 unit student housing asset in Tallahassee that was built in 1996 and has X number of dollars in value add that can be added to it, I can take thousands and thousands and thousands of buyers in my database and narrow it down to the exact, 114 people who want this exact asset down to the brick, right? And so that allows me to make a few phone calls and it gets sold, right? And likewise, for, let's say I'm selling an asset for someone who wants to 1031 exchange that asset into buying another asset, If that seller has hired me to sell the asset and wants me to help them find a buy for it, I can likewise use my database based on their criteria to narrow down those 1,959 assets to the exact number of assets that match their criteria. Down to, the ones that haven't already refinanced, the ones that haven't already sold in the last 1 or 2 years, age and type of owner and when mortgages are coming up, all those things intersect in my database. And instead of, making phone calls to, 996 investors that own those 1,959 assets, I can usually narrow it down to under 50 phone calls for an entire northern half of Florida that could ever be purchased at that one time.
It seems like a very valuable spreadsheet you got there.
It takes a lot of work. It's every day. My team has to work in that database because every day something is selling, units are being added to existing complexes. Sometimes buildings are being torn down or burned down. Sometimes they're getting refinanced. All these things are happening on a regular basis. And that database has to be updated every single day so that it can be most accurate and most applicable to what I'm doing that day.
Now, Beau, I wanted to reserve a segment for you to talk more about the Florida market, which you already did. But in terms of how is the situation right now economically, and what do you think will be in the next months?
Sure. It's super strong, man. I mean, there's the market rate side of things has not, not been anything less than fantastic, even through COVID. I think I've only heard of 2 distressed assets in the last 2 years since COVID, or last year and a half since COVID. And any distress I've seen has been either in low income housing that's not government funded, right? So the affordable housing assets have actually done extremely well because government pays the rents plus tenants. It's the lower income stuff that's not part of any program, that's in bad locations. Those have not fared as well because some of those tenants have taken advantage of the eviction moratorium. But again, those are very few and far between. Everything I've sold has done very, very well. On the student housing side, what's happened is that the assets that do well are the ones that are the closest or walking distance to campuses. The ones that are driving distance or further away, those have suffered more in terms of occupancy and rents because so many bedrooms were built very close to campuses in the last 3 years that now those assets that are further away, it becomes more difficult to keep students there. And the only thing you can do is drop rents. And eventually those assets become obsolete and they become converted to market rate assets. But looking into the future, I see nothing but bright spots. I don't see any headwinds that could create issues. Even when the tax plan changes, which I think it will in 2022, I think the Biden administration will raise capital gains. I don't think they'll do anything with 1031 exchanges, but even when they raise capital gains, I think it'll be a small blip for 2022. The number of transactions will probably decrease. But by 2023, if you're in real estate and you make your living in real estate, you have to trade real estate. And so things will change a little bit, but the volume will start to pick back up. And by 2024, 2025, we'll still be back to normal on the number of transactions. Now, I still think that, the tax plan change is not going to create any kind of increase in taxes for the government because people adjust and they find ways around things. That's just the way it is.
You seem to have a very positive crystal ball. And yeah, I hope that in this way you'll keep your momentum going. No, but if there's one piece of advice, this generic question on podcasts, you're already ready for this. If you have one piece of advice you could impart with the audience, what would it be?
I mean, there's the 2 most important things that you could ever learn and master in the real estate investment business is number 1, partnering with brokers, right? Because Brokers are transacting over 90% of all multifamily assets. That's a fact. I did a 5-year study. I've talked to brokers in other markets. It's the same way. You know, whether Texas might be 75% and New York might be 80 and Florida is over 90 and some other place might be 75 or 82, whatever the hell it is. The point is the vast majority of assets over 10, 20 units are brokered by a broker. And it makes sense because sellers are choosing them because they know brokers can create lots of multiple offers and drive up price, right? So your time is much better spent developing relationships with the brokers so that they bring you deals on a consistent basis. That buyer who does that will always significantly outpace the guy trying to go directly to the seller. It doesn't make sense for sellers to sell to some guy off the street they don't know. It just doesn't, not on a regular basis. And number two, your reputation is the most important thing in this business. That means, you know, going through a transaction from soup to nuts, from letter of intent to closing in a manner in which you leave all parties at the table feeling like they can't wait to bring you another deal and do another deal. Unfortunately, it's not as much as it doesn't happen as many times as it should, right? People retrade on things, people belittle properties, they say things, they get bent out of shape, they lose their temper, they come up with ridiculous things in a contract, whatever the case may be. There's a lot of interactions during a transaction between buyers and sellers and brokers, property managers, leasing agents, attorneys, phase one consultants, surveyors. All of these people are watching from either up close or afar how you perform in a transaction. And all of those people I mentioned are friends with other people in that industry or across industry. Even a guy who's doing a phase one environmental for you, who hears that you defaulted on the purchase, is friends with lots of other sellers, and they talk. And over a 5, 10, 15-year period in your investment career, as you develop either a good reputation or a bad reputation, it greatly affects how many deals you see in the future. It just does.
Yeah, and this is not an impartial advice just because Beau is a broker here. We've heard this before on the podcast.
Yeah, it's a statistical fact.
Yeah, it's the veracity of the advice cannot be disputed. We've heard how important are with broker relationships and the reputation is in your business. And now a bit of a personal question. Let's see if you can take it. And but I ask all our guests, so
sure.
you have to. So it's a question that no one wants to hear. In what areas do you feel you need to improve, and what are you doing about it?
That's a great question. I'm always, two things that I'm always trying to read up and learn more on, because I feel like it's such an ever-changing industry that unless you're in the industry, you can't keep up. And that's construction costs, construction and renovation costs, right? I would love to have the same knowledge I have on the investment side of multifamily as contractors and renovators do of the cost of these projects, right? And so I'm always trying to, I'm trying to read up and learn from the actual practitioners on what things cost. And number two, the lending industry, right? I feel like I'm pretty good on that, but I would love to understand more about the different products that are out there and the different ways you can finance projects to the benefit of the buyer.
Thanks for sharing that. I hope it works well with that improvement.
Yeah, you bet.
Now, but how can our audience reach you?
Sure. 3 ways. Number one, I got a website, beaubeery.com, BEAUBEERY.com. On there, probably the most popular button at the top of the screen there is resources. So when you click on resources, I have templates. I got letter of intent templates, guides, just a bunch of cool things on there. I also have a bunch of neat reports that I've done in the past that are popular, but also there's a drop down that shows all the markets that I cover. And whether you do business in Florida or not, if you click on one of the markets I cover, you'll see all the metrics that I track in a market. And if you can master those metrics in your market, you can become an expert. Number 2 resource is my YouTube channel, Beau Knows Multifamily. Just type that in. I do a video a week that is really, really rich stuff. It's not generic stuff. It's really rich stuff that allows you to, or shows you how to build a big portfolio. I also, from time to time, will put new listings on there that nobody knows about. It's just a fun thing I do. And then the third thing is, I would strongly suggest you buy my book. I'm not telling you to buy my book because I make a bunch of money. Anyone who's written a book will tell you don't make a bunch of money, creating a book. But this book right here, Multifamily Investors Who Dominate, that's what it looks like. It's on Amazon in hardcover, it's on Audible, and it's on Kindle. That is the actual Bible for how to really, really grow a business very quickly and to maintain and sustain a business long-term in multifamily.
And thank you very much for all these resources here offered to us. I thank you also from our audience to you. And yeah, I've been surfing those resources as well, and they look neat, as you say.
Awesome.
And yeah, thank you both for coming. I've realized you are the broker. If I really want to connect with a broker, I'll give you a call. Okay.
Thanks, Tomas. I appreciate that.
It was a pleasure. Have a good one.
Thank you.
Bye.
Thank you.